Hi there, welcome to Kneppy Invest, and welcome to the very first video in this financial year 23 results series. And I'll be looking at Nick Scali first, and one of the reasons I'm looking at Nick Scali first is because they're one of the first companies to release their results. They released their financial year 23 results on August the 11th, and I didn't want to wait a little bit before I did this video. In fact, I was planning to release this video about 3 or 4 days ago, but other things came up, well, urgent videos came up in the meantime. Nick Scali is a high quality company on the ASX into furniture, retail, fairly interesting business model. I think I've never been to Nick Scali's store. And what I've heard is if you go into a Nick Scali showroom or something and you like a bit of furniture, you order that furniture and then you don't pick it up straight away. You wait for it to be manufactured or something. And it takes about 12 weeks before you actually get to pick it up. So a fairly unique business model when it comes to Nick Scali. Maybe that's also an indication that you can alter the furniture to your liking. I don't know. Anyway, Nick Scali has been a fairly successful story on the ASX over the past 10 years. We'll look at the 10-year history in terms of revenue, earnings per share, that sort of thing, and you will see some really good growth over that 10-year period. And I would consider Nick Scali to be a high quality company. It doesn't mean it will remain to be a high quality company over the next 10 years, but as we all know, history doesn't repeat, but it often does rhyme. So if a company has performed well over the past 10 years, there's a better chance, a better probability that it is going to perform fairly well over the next 10 years. So let's have a look at Nick Scali's financial year 23 results. And starting off with revenue up to 507.7 million, which is an increase of about 15% from last year. Another thing to keep in mind about Nick Scali is they did make an acquisition 2 years ago, October 2021, of Plush. So that has enhanced revenue growth over the past 2 years. I believe most of that acquisition was through debt. So they haven't increased the shares on issue, which is very important for this company. In fact, it's very important for all companies. When you look at the shares on issue for this company, it's flat over the past 10 years. So there's been no dilution for shareholders. Profit up to 101.2 million. That's an increase of 26.1% on last year. Gross margins up to 63.5%. That's an increase of 250 basis points or 2.5%. The most important thing about gross margins, it's increasing over time. So over the past 10 years, it has increased and it's increased again, which tells us there is a bit of pricing power when it comes to Nick Scali. So any increase in cost, they can pass that on to their customers. And that's very important. Operating cash flow, 101.5 million, which is fairly similar to the profit. I calculate operating cash flow a little bit different than the market. So operating cash flow that Nick Scali would have provided to the market would have been about 137 million or something like that. But I take into account lease liabilities because, in my opinion, leases are part of the business, the day-to-day business of a company. And free cash flow, which is just the operating cash flow minus capital expenditure, up to 89.2 million. Some other numbers they did report on: EBITDA up 21% to 197.1 million, EBIT up 23.8% up to 154.3 million, and final dividend per share 35%, which is flat on last year, but the total dividends for the year 75 cents, which is up 7.1% from last year. Return on equity for Nick Scali is unusually high, 56%. The return on equity for this company is always, or over the last 10 years, has always been really high. So fairly low equity. So we're talking about equity of about 170 million, profit about 101 million. A return on invested capital is a little bit lower because they do have a fair bit of debt, about $90 million of debt, 37%. Now, some people will include lease liabilities in the debt. I don't do that. And that's why debt to equity is only 0.51. Now, equity was 170 million or something like that. If you include lease liabilities in the debt to equity is significantly higher than 1. So that's why you might see different debt to equity numbers if you look at different investing platforms. Shares on issue, 81 million. It's been 81 million over the past 10 years. And at a share price, about $12.20 or something like that. The market cap of this company is roughly $1 billion. So straight away, when you see the market cap of this company, $1 billion, profit over $100 million, that should say possibly the PE ratio, not possibly, the PE ratio of this company is less than 10. So let's have a look at some of the valuation metrics for Nick Scali, where it stands right now on August the 19th, 2023. And indeed, the PE ratio of this company is 9.8. And that suggests to me that with the past growth this company has experienced, and you'll be able to see that growth in the next slide, that if this company can maintain any sort of growth, it is undervalued at these levels. And the other thing it suggests to me is the market is a little bit hesitant, a little bit wary, a little bit cynical about the future growth of this company, particularly in financial year 24, possibly even into financial year 25. But I think the market is being a little bit too short-sighted in regards to Nick Scali right now. Price to sales ratio 0.49. Don't really focus on that. I do focus on price to operating cash flow, and I'll also focus on EV to EBIT. So price to operating cash flow 9.8. EV to EBIT, which I haven't showed you here. EV is around about 260 million. EBIT is 154 million. So EV to EBIT is well below 10 as well. So most of the valuation metrics I do look at are below 10, which suggests to me that this company is definitely not overvalued right now. If anything, it might be argued to be undervalued. But again, the market is a little bit skeptical about the future growth of this company. And when I say future growth, I'm talking about the short-term future growth. I think the future growth over the next 10 years is going to be pretty good for this company. And I did a reverse DCF. So what is the growth of this company have to be to justify the current valuation? And that growth is in earnings per share. So you could use operating cash flow, free cash flow. For Nick Scali, I just use earnings per share. So to justify the current valuation, earnings per share will have to grow at 2.7% per year over the next 10 years. Now, in the next slide, I'm going to look at the earnings per share growth over the past 10 years. So if this company can achieve the earnings per share growth it has seen over the past 10 years, definitely this company is undervalued right now. So this is the compound annual growth rate for Nick Scali in terms of revenue, operating cash flow, profit, and price. So profit is just earnings. Now, because shares on issue haven't increased over this time, all these are in per share numbers. So not really per share, but because shares on issue haven't increased, this is sort of a proxy for per share. So revenue has gone from 141 million to 508 million. And also be aware that this company did make an acquisition 2 years ago. So that has increased revenue, operating cash flow, and profit because of that plush acquisition. But revenue has grown at 13.7% per year, operating cash flow 16.3% per year, profit or earnings per share have grown at 21.7% per year. And definitely, I don't think this company won't grow at that sort of rate over the next 10 years. I think it'll be a little bit less, just because the size of this company is significantly bigger than it was 10 years ago. But I definitely think it can grow more than 2.7% per year. Share price has gone from $2.71 in 2014 to $12.24 in 2023, or where we stand right now. That's a nice increase of 16.3% per year. That's just capital gains. That does not include dividends. So if you include dividends, you had seen a return well above 20% per year. You also notice operating cash flow, price have increased exactly the same rate. So that's another reason why this is a high quality company. All these compound annual growth rates in all these financial measures are above 10. In fact, operating cash flow, profit, and share price are above 15. And the last thing we want to look at is the chart. And this is the chart of a high quality company. Share price going from the bottom left to the top right. And at periods in time, the share price does nothing. In fact, there was a period of time between 2017 and 2020, share price went sideways, then there was a COVID-19 dip, and then a massive bull run in the share price between 2020 and the end of 2021. Share price actually went from about $3 up to $16, and share price has been struggling because of perception in the market that as we move into a possible recession and as interest rates rise, people are going to spend less money and less money on furniture. And the other theme was that people have already spent money on furniture during the COVID-19 lockdowns, which is possibly true. But still, performance of this company was pretty good in financial year 23. And I would expect financial year 24 numbers to be a little bit lower than what this company saw in financial year 23. If this company grows in financial year 24, which would be against expectations, I think this company is really undervalued right now. Whether that happens remains to be seen. But if the company really surprises the market, I think this is a potential buy at these prices. So if you do have any questions about Nick Scali, if you are a shareholder of this company, I'd love to hear your thoughts. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.